And good afternoon, ladies and gentlemen. Please go to your seats promptly. We've only got 35 minutes, so this is going to be a short, snappy session. It's on the webinar as well, so the millions of people who are watching from home can post their questions and they'll appear on my iPad here. So I'm delighted today to introduce two speakers to talk on the future of DC. Given that DC is going to be the future of pension saving in the UK, we thought this was an appropriate topic, and in particular thinking about how we can expand the range of asset classes that DC funds and particularly DC default funds use. So first up will be Michael Hanna, who's come all the way from Australia. He's head of Australian infrastructure for IFM Investors.
Good afternoon. Thank you, Mark. And yeah, I've been given 10 minutes. It's the presentation equivalent of speed dating, so it's probably going to be the shortest presentation I've ever given. So hopefully I'll hit some of the highlights and high points for you and create some issues for discussion. Okay, that's me. I just wanted to give you, first of all, a bit of an introduction to IFM, not because I'm here to promote or market the company, but because of our unique ownership structure, I think speaks to quite a few of the issues that pension funds are experiencing today, particularly with a view to investing in illiquid asset classes and particularly infrastructure. IFM Investors has a unique ownership structure. We're actually owned by 30 industry superannuation funds in Australia. Industry superannuation funds are a particular segment of the super fund sector or the pension sector in Australia, representing around 35% of total investment funds in superannuation. So that was over 20 years ago that we were established, and you have to ask yourself the question, why did 30 industry funds come together and create a fund manager? And primarily it was due to the situation they found themselves in. It was a pretty young sector. Each of these funds was very small, but they are all like-minded. They all had a similar approach to investing. And what they did was simply get together and discuss how they could create scale benefits. How could they get efficiencies from working together and deploying capital on a coordinated basis. And rather than do it informally, they decided they would actually create a fund manager. They also created other services company. They created a bank. But it was a very much a collective approach to investing to get those scale benefits, get the efficiencies, get access to world-class investment capability. And importantly and crucially, a key driver here was one of alignment with a fund manager. So a fund manager being created not to generate fees, to generate profits, but to be in existence to generate the highest return possible back to its owners. So that's our business model at IFM. We make profit, of course, to invest back into the business, but not to the point where we're lining people's pockets, other shareholders, a listed market. We're simply here to provide returns back to our investors. In Australia, as you may know, we have a compulsory superannuation sector. It was introduced in 1992, so it's been running for 23 years. 9.5% of my income or my salary every year goes into my super fund. And this compulsory super sector has now grown to quite extraordinary size. It's now bigger than the Australian Stock Exchange. It's about $2 trillion in size. And in the next 15 years, we'll get to about $6 trillion. That's a great number. It's a great capability that we have. We're one of the top 4 pension funds in the world, but it does create some problems. We're a country of 24 million people. There's only so much you can invest in Australia, and our owners certainly implored us to move beyond Australia over 10 years ago, and now we have offices in London, New York, Tokyo, Berlin, and are investing in world-class infrastructure around the world, including the airport just down the road here in Manchester. So that's a little bit of background about us and who our owners are and why we were created. I've just got a slide here just to capture some points around particularly liquidity and fees, because I know those are two key issues for pension funds here in the UK when they're thinking about liquid asset classes and particularly infrastructure. Just first of all, DC membership. We are dominated in Australia now with defined contribution funds. Roughly it's 95% of all members or superannuants are in DC funds. Compared to 30 years ago, it was only 20%. So from 20% to 95% in 30 years. So it's absolutely dominant in the sector. In terms of infrastructure allocation, there is a strong tradition of investing in this asset class. On average, around 5% of asset allocation is in infrastructure, particularly across industry funds and government pension funds. Some funds are actually achieving or targeting above that level, and some are actually at 15-20% exposure to infrastructure. Why is that? Well, primarily because of the returns they've enjoyed. We've been running our Australian fund for 20 years now and delivering almost 12% after tax and fees to our super fund investors. So obviously that is a very attractive return. Their experiences have been positive, and over time they develop confidence in the sector and keep allocating a reasonable proportion to it. I'll take three of these points just together, GFC, regulation and liquidity. If we just look at liquidity, first up, industry funds, particularly in Australia, have a very young membership base, but they take a long-term perspective when making investment decisions. By doing so, they will increase the probability of achieving their investment objectives. But by doing it, it is actually creating a mismatch with the fund's liability profile. And the question, why is that? Primarily because of a concept in Australia called member choice. And every superannuant, including myself, I can switch out of my industry or my super fund today at the click of a button, or I can switch my allocation from equities to cash, or I can buy BHP and Rio within, say, a click of the button. And that creates significant liquidity challenges for super funds in Australia. This duration mismatch, investing for the long term, but having that risk of people changing their minds literally minute by minute, day by day, is a key factor or constraint when funds are designing their approach to managing liquidity risk. The regulatory construct and authorities in Australia do require active liquidity management by trustees, and plans have to be in place and approved by boards and assessed and monitored on a monthly basis. So very active management of liquidity. Key test of liquidity was, as you all know, during the GFC, and unfortunately we had a lot of experiences where through that member choice, people were literally clicking buttons, moving their exposure out of equities, bonds, etc., and into cash, and crystallizing losses. And that was put a significant amount of pressure on our owners and other funds, and we're getting a lot of questions about, can we liquidate assets and can we give them liquidity back to the fund as a way to manage that switching activity that was taking place. That experience, while it was pretty negative at the time, it actually turned out we had no redemptions from our funds. We had over 15 billion invested and not one redemption through the GFC, so lots of questions were asked, but no redemptions were actually made. But that experience is really formative for the Australian funds, and they use that experience to now pressure test their liquidity plans on a monthly basis. Thank you, Mark. Finally, on fees, in a low return environment, everybody's focused on getting the most out of what managers are providing, and Australia is no different to UK, US, elsewhere around the world. A lot of pressure on fees. For us, it's not such a big issue, just given our business model. We're here to maximize returns, not to maximize profits for us as a manager. But certainly a very vigorous debate taking place in Australia. And to the point where funds arguably are cutting their nose to spite their face, not investing in asset classes which should give high returns, infrastructure, private equity, because it's costing more than they feel comfortable with managing, and also a trend towards insourcing and bringing the risk of investment decisions and active management in-house, again to drive fees down, but The big question is, at what cost? And finally, just a summary of one of our largest owners and investors, and just to give you a little bit of a feel for bringing this to life. This is a very large industry super fund. Tier 1, if you look at the left-hand side, we've got 33 billion invested, moving anti-clockwise. Their key liquidity management tool here is roughly 10% of inflow on their current NAV year in, year out. So they're getting 3 billion in the door every year, and that cash availability to them on an ongoing basis is their key liquidity tool going forward. Return objective 4% plus CPI or CPI plus 4. We're giving them 10, 11% in infrastructure. That's obviously accretive to their returns. And they have about a 10% allocation, but that will increase to around 15% over the next couple of years. And their total of liquids is targeted around 35%. So they're very comfortable taking that long-term view, paying a little bit more on fees, but getting an accretive return to their portfolio. I'll stop there, Mark, and let David say a few words. Thank you.
Opportunity for questions after. And now introduce David Hutchins, well known to all of you, I'm sure. He's no introduction, but he's head of pension strategies at the newly branded AB.
Thank you. So I realise 10 minutes is not long, so I've only got 25 slides for you to get through in this process. So with that in mind, I'm going to quickly skip through the fact that I still think default strategies as the best way to drive value for money and better outcomes for members of DC, and also skip through what the features of those default strategies should look like, and really get on to what my wish list was when someone said that the title for this was Looking to the Future. And I came up with 4 things: improving value for money, retirement income, using illiquid investments. I always find illiquid's a weird word. I think they're solids or gas, and assuming they're not hot air, this is more about the solids. And then objectively measuring outcomes. Even that's too much for today, so I'm going to look at the illiquid bit and then a bit on value for money. But I don't know if my colleagues talked this morning, you had heard about value for money already and taken all your notes there. So let's talk about liquidity. What is liquidity? So I think a lot of people will be familiar with some definitions of this, so I'm going to give you my definition. The first part of liquidity is there a market? Is there a buyer for what I have out there who will buy and sell my stuff? And the second part of it is there fair pricing? Is there a wide enough list of buyers and sellers such that I can actually get competitive pricing in the market? Now, interestingly in DC, where you're running default strategies, is you don't really need much marketability, because hardly ever do 99% of the membership turn up at the door on one day and say, I'm selling up. Yeah, you're moving very small amounts of money around. All you need really is some kind of way of fair pricing everything. So we don't really need that depth in market. What we do need is fair pricing. So that's the first thing we have. So why do we have this problem where we can't get illiquids in DC structures here in the UK? And I know actually it was interesting listening to the bit of Australia, is they've had a similar issue. And I think the first thing is the way we construct our strategies, where we construct them as individual solutions. So we actually have to have individual liquidity at every single member level. They invest in individual asset classes or individual funds. Now this one's relatively straightforward to deal with because we put them into some kind of multi-asset fund where an asset manager or someone who actually aggregates funds together can deal with liquidity for you. So whether that's a diversified growth fund or a target date fund. Slight benefit in doing this on an age-based approach because you can actually know how much liquidity you need for a youngster relative to someone who's older on in the strategy. So I think the first issue we have to deal with is we may have built our system in a way that doesn't allow us to access illiquidity. I think the next bit is we deliver most DC here in the UK today for our insurance platforms. And they have liquidity requirements as well. This is a strange way to deliver our product in this environment. In fact, actually, it was kind of tells you where DC came from in the UK. It was developed as a retail proposition. It was developed for people who like trading funds. Whereas, actually, if you think of what's happened in Australia for the supers, it was developed as an institutional proposition. So it's actually slightly easier in Australia, where people aren't kind of having to provide liquidity every day. So let me just talk about, the benefits, pros and cons of being on a platform and not a platform. I realise for anybody anywhere kind of beyond the first few rows, this is a real eyesight test, by the way, so I'm sure they will be available afterwards. But let's talk about the benefits of being on a platform. Well, or the issues of being on an insurance platform, which is where most of us are today. Permitted links restrictions. There are restrictions about what kind of assets you can put into insurance companies for use within DC. That's a problem. Has to be a UCITS fund, has to have certain liquidity requirements around it. There's capital costs of the insurer, adds to cost, and then there's the uncertainty around FSCS ownership of assets and security of DC in the UK today. If you come off a platform, why do we use platforms? Because they provide scaling. It's a nice scalable place. You need scale. If you're 300 or 400 million, you probably don't need to really be on an insurance platform. You can build your own solutions in segregated accounts. You can own the assets. You can build better solutions using illiquids. There's an industry mindset that says we must deliver everything onto insurance platforms today. I think we'll see that change. And it starts exposing cross-subsidy, which is that actually the default is cross-subsidising lots of individual self-select options, where the costs are actually probably higher if you allow for the way in which it works. The benefits for coming off the platform are you get more investment freedom. You're not subject to permitted links rules. You can start putting more interesting investments into the strategy. You have direct ownership of the assets. You can vote on them. You have absolute security in event of insolvency. And you have reduced costs at scale. So as we get bigger and bigger, you don't need that extra capital cost of the insurer in the middle. So it's interesting when we look at the Australia and the US markets where we work, that actually most big schemes, big default strategies are not built on insurance platforms. This is a big shift for us. We've been growing in DC today. Everybody has in this room through this, and we started off small, and we built it in the most efficient way. But perhaps in the future we need to kind of think about different ways of delivering DC. It's interesting, by the way, Nest, talking to Mark earlier, uses a non-insurance platform delivering its default, which gives it more investment freedom. So an alternative way of looking at this illiquidity problem is thinking of other structures where we can access illiquid assets, and closed-end funds could be the way forward here. And so anybody who wants to know what a closed-end fund is, an investment trust, alternative to that could be any stock on the stock market is essentially a closed-end fund. You raise money, the money's put to work, and people can trade shares in that stock, but they can't actually sell up. So I can't invest in Tesco's, and when I sell out, say, well, you need to sell some stores or whatever. You're selling the stock to somebody else. So closed-end funds are potentially a way forward. So investment trusts, the funding guarantee means that you can invest for a long time in these things. And there's a secondary market to provide marketability and fair pricing in these things. So actually you can get to these things. So there's already real estate investment trusts, there's private equity investment trusts out there, there's other closed-end vehicles, and we're seeing more and more innovation in this space. But there are issues. I'm not going to say this is a dream solution for everything. First of all, it's best accessed by a multi-asset fund anyway in the middle. So you still need some kind of investment manager to actually invest in that. Very few DC schemes today invest directly in the stock market. They invest via some kind of collective vehicle. The governance of the structure is complex to oversee. So if anybody's been watching the trials and tribulations of Alliance Trust in the UK in recent times, you understand some of the issues that investment trusts can face in this space. And funny enough, and this is the thing that I've discovered over the time, is as soon as you start making your illiquid assets illiquid, they start behaving exactly the same as the rest of your assets. So if you're doing this for diversification and diversified returns, you suddenly find actually they start behaving very similar to your equities and bonds you already have. So you start taking away that kind of value you saw in the illiquidity premium in the first place. Internal management costs and discount to NAVs of investment trusts and closed-end vehicles create huge issues for a lot of people investing in them as to how they think about them. So closed-end trusts could be another way of getting to this illiquidity premium. Value for money, just a very quick one on here is, I think we're going down this route of starting to say, where's the money spent? Are people going to start being clear about the budget that we're using for DC? And should we start breaking it down between what we spend on admin, what we spend on compliance, and what we spend on investment? And what really is DC? It's an investment product. So how much are you spending on investment? And I think our thoughts on this is really you should be aiming to maximise the investment spend if you're trying to get better outcomes. These are the kind of questions which I know Tim took you through earlier this morning around how how trustees should be addressing the investment budget. What is it? Could everybody disclose to their members how much they spend on investments? Is this a 75 basis points product or 0.75% product, of which only 0.05% is spent on investment? Or is it more of it spent on investment? How do we feel when we go into the supermarket to find less than 10% of what we spend on an apple goes to a farmer at the bottom, and most of it goes on distribution costs? Would spending more give a better outcome? A good question for trustees to ask themselves if we're thinking about value for money. Am I spending enough on investments? How do you allocate the investment budget? What's your process if you've got a tight budget to allocating that? How do you make sure you get the best value for money out of your investment budget? And can you get what you have cheaper and or better? Which is basically a brokerage point at the end, is could I actually get this done cheaper by just shopping around a bit better? So should value for money be about better outcomes rather than just cheaper ones? So finally, just some ideas and some statements that trustees probably should be making around value for money in the investment budget. What is the investment budget, and are you building to be best, or are you building to be best for a price? How do you feel for your DC scheme? So my hope for the future, I think we're going to increase the investable universe by going more into illiquids within DC. I think there's stuff coming along in that. It will become around building better ways of actually constructing the default. It'll come about whether we go off-platform or off-insurance platforms for delivery of that default. And also it'll be around whether we can have direct ownership of assets, albeit by closed-end funds. And then when it comes to investment budget, we're going to start answering these questions about what it is. But value for money again, best net outcomes, not just cheap ones. Thank you.
So we've got about 12, 13 minutes for questions before you can get to your champagne or first drink of the day. I've got a few questions, but I wanted to give the audience a chance. So are there any questions? I think we've got some roving mics. Would anyone like to ask the first question? No, I will kick it off then, and you can be thinking while I'm asking. One from Michael, I think, first. Infrastructure is a very fashionable asset to invest in for DB funds, etc. There's a lot of dry powder, a lot of money pent up trying to get into infrastructure assets already. How could we make this good value for DC investors?
Mark, there's no doubt the weight of money in the asset class now is bigger than it has ever been, and that's not something I say with a lot of pride, because it simply just makes things much more difficult for ourselves to try and secure good investments on behalf of our investors and members. There's definitely pockets of the market and areas of the market where there's a lot of heat, and we have made a decision to not participate in pursuing certain subsectors and being active in certain geographies. For us, the deals, and we've said this to our investors, the deals are just going to get harder to do. Not riskier, but harder. And by that I mean, some of our deals are taking several years to do. So we try and avoid public auction processes as much as possible, where every man and their dog's basically lining up, and it's super competitive, and it's a cost of equity shootout. But we're looking for that pocket of interest and activity where there's not a lot of other people looking. We, based on 20 years of investing experience, we're really working relationships and looking to partner with owners of infrastructure to share on those assets going forward. And our investment here in Manchester Airport's a prime example of that, which was over 2 years in the making, really using our partnership credentials to partner with the authorities here to acquire Stansted and provide significant weight to the investment capability that was already in existence. So that's an example of something that just takes a lot of time to do, but there's good value there, and we see value there over the long term, 30, 40, 50 years. For us, we're trying to avoid that weight of money, Mark. And
but as you pointed out, your Australian super funds are still growing, they're still cash flow positive, so they want to put that money to work. Do you have a problem? Do they just keep giving you money you can't invest?
I hope it doesn't become a problem, but look, certainly we don't have a monopoly on even our owners' capital that's allocated to infrastructure. So we have to, while they own us, we have to compete for their money, and they have manager concentration issues like everyone else. So for some of our clients, they have an exposure 60, 70, 80% to us on infrastructure alone. So we understand that they will be looking at other managers and other strategies that we don't offer to have their money sort of move in that direction. So we're competing all the time. We need to find a home, but we're not going to blow up 20 years of track record just to be hasty to get money out the door, Mark. We need to be patient and disciplined.
Great. Thanks so much. Are there any questions in the audience? Because I've got another one for David. Investing in investment trusts, that how does that get around? Does it get around the charge cap? Does it how does it interact with that and other regulations?
I guess am I live? Yes. I guess on the charge cap point, it's not really getting around it. It's the same as investing in any stock. If you're investing in a stock directly in Shell, you don't take any allowance for the management of Shell in that. So,
but if you invest in an infrastructure share, right, they're charging a management fee, which you don't include in the total expense ratio.
No, but it's in the price of the share when you buy it.
Right.
So it's the same as when you invest in Shell or BP, there's a management fee for the ongoing management of that company that's in the price of the share. So I think, there's a market that prices that in. So you probably... I think to think of it as getting around the charge cap would be not to understand the nature of the investment.
But if you invest directly in infrastructure, you've got to take account of those charges in your total expense ratio. So that seems like a unlevel playing field.
Yeah, no, I get it, and I think it's one of the real problems we have with the charge cap itself, which is some things are measurable and therefore we include it, and some things aren't measurable and we don't include it. And there's take a bank is probably a great example of what is a financial institution. It has very high overhead costs, but they don't go into the charge cap calculation. Whereas if you were to build your own kind of bank-like thing, which is a corporate bond portfolio managed by a manager, then you would take the cost of that management into account. So, like for like is difficult.
Right. Okay. Do you have any charge caps at all in Australia?
There's no hard and fast limit on MERs is the acronym we use in Australia.
Super funds typically charge about 50 basis points?
Yeah, anything between 50 and 70 would be a target range for the cost of running a fund. And we, as a manager, are looking to beat that and actually give them something that comes in under their MER cap, and obviously give them a return that's going to beat their return objective. The example I put on the board, they're targeting 6 to 7%. I can give them 11 at a fee just below the MER, and that's a win-win for everyone, and that's a good outcome. But this example I showed, they also invest quite heavily in private equity, and they're one of the few funds in Australia that has a strong and consistent track record in that space. You look at the fees they're paying on private equity, they represent around 30% of the total fees they're paying out on the fund for about 15% of the overall return back to members. So they're willing to pay fees over and above their MER target, but to get a return on an opportunity to outperform their return objectives. So they're not going to be beholden to a target for the sake of it. They will prudently spend more if they think they're going to get a good return and outperform their return objective.
Right. So David, do you see private equity coming into DC portfolios?
I think as we build the structures, certainly. I mean, it's finding the right allocation to these strategies, but we're getting more sophisticated as we go forward. So private equity, infrastructure, private debt, all things that are starting to become available for us to invest in within DC strategies, so long as you have the right kind of structure in place to do it in the first place.
Okay, great. There's a question at the back over there. Thank you.
Thanks. It's Peter Hunt at T. Rowe Price. I just wanted to ask, it often feels with DC like it's the operational tail that wags the investment dog. And I'd just be interested in your views on whether there is a better way to do DC pricing and DC trading rather than having to have daily liquidity.
I'll take that first. I mean, I guess that's kind of what I've been saying is let's not build all the liquidity at the member level, but build it within a collective trust. I think we're going to have to get trustees or somebody in the middle who's prepared to accept some kind of fair pricing mechanism for when we're having individuals trade. But and what I mean by that is if someone's selling out of a default strategy, there'll be one member of many hundreds of thousands potentially selling out. So they'll represent a very small percentage of that fund, but they're selling their own little percentage of that illiquid investment at that time. And therefore we need to make sure there's a fair price around that as they sell out of that piece. Not that we actually sell the illiquid, it just gets reattributed to the rest of the membership. And there are mechanisms in place for doing that, but it will require trustees to get themselves comfortable with that. It's very difficult within the insurance-based world because of the way they work, but I think trustees, will get there.
So you'd use some sort of proxy price between valuation periods?
There are a whole bunch of methods available out there, so yeah.
And do you know what happens in Australia?
Yeah, look, one of the sort of key themes that's prevalent across the sector now from a liquidity point of view, and it was going back to the point I was making about the GFC and member choice, that click of a button risk that exists where you can switch out of any allocation in your super account to something else, and the super fund's got a major headache to try and manage that. What they're trying to do now is embark on a concerted program of member education, and they've got a big task ahead of them because people with superannuation accounts in Australia, typically a younger demographic, they don't care, where it is, what it is, how much it is. Certainly not now, maybe not for the next 5, 10, 15 years. So actually trying to get to them and educate them is a bit of a challenge. But all of the funds, particularly the larger ones, are making a concerted challenge to educate their members, particularly around this switching issue, and educating them that if they switch out of equities when there's a big dent in the stock market, then they've actually crystallized a loss, which they'll really struggle to recover. Whereby if they hold on and ride through the period of disruption, those equities will come back and the value will be sort of captured back. So that's a big change in the last couple of years, Mark. Really concerted education programs by all funds across their membership base to get them to stop switching. It's seen as a big feature, an attractive feature, but it does cause a lot of headaches. And the more you can inform people around what they're doing and what are the downfalls of using that flexibility, the better.
Okay, great. We've got time for one last question. Up front here, please.
Hi, Louise Howard, University Superannuation Scheme. For Michael, I just wanted to ask there to understand a little bit more, if you wouldn't mind, of the active liquidity management requirements, as I think you, if I've made a note correctly, called them, just to understand in brief what those look like, really.
Okay, well, this is second-hand insight into some of our owners here and how they actually manage their liquidity. So, as I said, they have a plan that they have to have approved by the board and submitted to APRA, which is the regulatory authority. APRA doesn't actually state hard requirements around liquidity, only that there must be a liquidity management plan in place, approved by the board and actively managed. And looking through one, you'll see that across each of the asset classes that a super fund will invest in, they will attribute a degree of liquidity to it. The key definition is one of if you can crystallize the value of an investment within 90 days, it's liquid. If not, it's illiquid. So typically, infrastructure, private equity, timber, those categories are all falling into the illiquid asset classes. They'll usually put a hard sort of cap on their exposure to illiquids. In this case, the case study was a hard cap of 42%, I think, and they managed to that hard cap week in, week out. They can go over it for over short-term periods, but effectively they're trying to keep exposure below that hard cap level. But they're in a great position, whereas you have that liquidity coming in, day out through the compulsory superannuation system, young membership. They're keen to perform well and attract new members all the time, and a relatively young demographic as well. So they're in net inflow mode for the next 20 years. So liquidity's a challenge, but with a small c, if you know what I mean.
Okay, great. Did you want to?
I was just going to add,
Should we-
I think it's one of those things we get to, the reality is even during 2008, when we look at our book of business around the world, less than 5% of TDFs or people in default strategies actually traded. I mean, it was tiny. I mean, it was probably more like 1 or 2%. And so we're almost building in far too much liquidity into the system. And it's kind of where I was trying to get to with the presentation is, why are we doing this? It's just madness. And it's because of the retail mindset that's almost built DC and not the institutional long-term savings mindset.
Okay, great. Well, thanks very much. We're out of time, unfortunately, so please could you show your appreciation to the panelists.